and as a broker who pushes the understanding of people doing this correctly. And I'm someone who is a huge advocate of avoiding and eliminating fraud for mortgage applications. I am so grateful that they're finally talking about actually doing something. I'm just not very grateful. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. Wow. Oh my gosh. This last week has been absolutely mind-numbing. I haven't got a lot of sleep. There's been so much happening. And if you are as much of a nerd around real estate and what's happening economically speaking as I am, then you're going to be excited about today's conversation, today's podcast. Now, not only are we going to talk about the Bank of Canada rate decision, which everybody knows what happened, but what they said was more important, but we're also going to talk and dig into the federal budget's new plan to help first-time home buyers get into homes. I'm going to give you some feedback on what I think the potential outcome is of that plan and some unintended or intended consequences of the plans themselves. But man, it's been a crazy last week here. And if you're looking to understand basically everything that happened over the course of this week, then I will be helping you to do so today. Now, this topic itself, whether it's the BOC, whether it's inflation, whether it's the federal homebuyers plan, deserves a lot more time, and we are going to devote more time to specific parts of this in a future episode. But today is going to be a breakdown of what actually happened so that you can go into your week knowing exactly what to think about, I guess, the BOC and the federal government's decisions. So let's get into it. All right. So as you know, we are here to help you guys out to figure out and understand what's happening in the financial markets as it relates to real estate. Objectively speaking, there's a lot of economists out there. I'm not necessarily trying to be an economist. My goal here with you guys is to help you understand what actually is happening and how it impacts you as a real estate buyer or investor or someone in the real estate industry as to how it could impact the market. So let's get into what happened on April 10th of 2024. Tiff Macklem and the Bank of Canada sat down and decided to hold interest rates at 5% to the surprise of who? Absolutely nobody. Nobody had any level of surprise. And I think virtually everybody expected 100% that rates were going to hold. But what everybody is expecting is rates to hopefully come down in June. And what's interesting is that Mr. Tiff Macklem basically said more or less that a rate cut in June is within the realm of possibilities. Now, why this is a big deal is because he's not admitted that. Up until this point, he's never once actually kind of insinuated that rate cuts were going to be coming in the near future. He just keeps pushing off and saying, yes, rate cuts will happen eventually when we hit X, X, and X. Now, with that being said, the BOC itself, so the Bank of Canada, is projecting only 2.2 inflation by the fourth quarter of this year. And for those who are following along, that is a good sign if you want to see the Bank of Canada start to lower interest rates. Well, essentially because they're working their way towards their 2% target. And the closer they get, the sooner that it provides a reasonable ability for them to actually start dropping rates. Again, there's a lot of people out there who think this is crazy. And because of what's happening in the United States right now, which is basically the opposite of what's happening in Canada, that inflation will not come down and we will not be able to drop rates because it'll absolutely kill the Canadian dollar and our overall economy will be hurt significantly because of it. And there's probably some truth to that. But the reality is at this point right now, that's what the stats are saying. And that is what Tiff Macklem has said. Also, importantly so, Macklem specifically said that inflation will continue to come down gradually, even as economic activity strengthens. So even if we see an economic strengthening in our activity, he does believe that we're on the right path to basically beating up inflation, which is, again, good news for you if you want to see prices stop to essentially stop going up the way that they are right now in most consumer goods and services in the marketplace. But I don't know about you. I mean, I was thinking about this the other day as I was about to open up my packaged salad and thought to myself, this cost $1 more than it did just 6 months ago. And I think it's about half the size. Inflation seems to be roaring and strong as ever, but apparently the stats say otherwise. Now, enough of my rant about my packaged salads, but looking at what's happening and why does it actually matter in regards to the United States? Well, there's a very strong correlation between Canada and the US, and US inflation just went up So with US inflation going up, you would think that would have a direct impact on Canadian inflation as a whole. But the interesting thing is, Tiff Macklem specifically noted that I don't see a big or direct imported inflation effect. Now, this is basically because we import US goods and goods prices aren't necessarily the problem, according to Tiff Macklem. Now, whether or not you agree or disagree, it is a real consideration. Now, I did mention the dollar or the loonie, and if you haven't looked lately, our loonie is not doing so hot. I mean, heck, if you guys didn't see the other day, the Mexican peso to the Canadian dollar is the worst. I think it was the worst it's ever been. But if it's not, it's significantly closer, where the peso is basically starting to rival the Canadian dollar, which is not a good sign. We don't want to see that happening. And ultimately speaking, if we start cutting interest rates before the US, then that could get even worse. Now, without going way too deep into that, let's stay on track here and talk a little bit about what's going on. Now, overall, it seems like the BOC is seeing things a lot more positively than a lot of critics. Essentially, a lot of people are saying that more or less, like, he's just waiting for inflation to cool down, which is not really a reasonable or smart approach to be taking at this time right now. But ultimately, that is what a lot of people are suggesting that he's doing at this time right now. There's a lot of different data and indicators that are out there that are suggesting that we are not in a position to be able to actually drop interest rates. And the market itself is even suggesting that those rate cuts that we're suggesting in June is actually a little bit too early, and we might not see one until July. Interestingly enough, what we've seen though since that time is that the markets as a whole have not only downgraded the likelihood of rate cuts coming in June, but they've also pushed back the likelihood of a steep drop and made it a little bit more quote unquote shallow, both on the fixed rate and the variable rate side, which is something we'll touch on here today. In a reaction to what happened, the bond markets really just took off. And if you don't know this already, fixed interest rates are specifically related to the bond yields. You can look at the 5-year bond yield to get a little bit of an understanding as to where fixed rates are and what's going on. And this is contrary to the spring market, where typically speaking, banks are often trying to actually reduce their interest rates. Well, right now, we've seen the bond yield jump up dramatically over the course of just the rest of the week, or the second half of the week, closing at about 3.85, which is basically as high or almost as high as it's been year to date. So those sub 4% or sub 5 3-year rates that we were seeing back in January have started to dissipate and have basically gone away for the short term. Now, a lot of this we'll see what happens over the course of the next couple of weeks. And remember, this could be dated, and there's a lot of things happening economically which can impact fixed rates. But these are just some of the things that you need to be thinking about when it comes to rates as a whole. There's just a lot of volatility as far as what's going on in the marketplace. Now, as far as what you should be looking in right now, I would, like, for one, would recommend that somebody who's thinking about getting into the marketplace. Now, I probably recommend this all the time for anybody, but if you're someone in the next 4 months, or April of 2024, and you're someone who's thinking about buying or investing, or you have a renewal coming up in the next 4 to 6 months, you should probably be reaching out as soon as possible to see if we can lock something down for you, whether it be a rate hold or an actual approval for you. Because if things continue in the current trajectory, we will start to see fixed rates inch their way up more than the quarter point that they have in the last couple of weeks here. And that obviously will impact the bottom line more so, and have a negative impact potentially on the housing market. Overall, our feedback there from a strategic borrower standpoint, or my feedback from a strategic borrower standpoint, is to really just be aware that the market is moving quickly. And what you're seeing from your friends or your family could be as old as 3 weeks or 6 weeks, which is basically yesterday's news. All right, that's enough about what's happening with the BOC and what's happening with interest rates. Let's talk a little bit about what happened in the announcement from our lovely friend Freeland, Chrystia Freeland, announcing the reintroduction, boom, of insured 30-year amortized mortgages, which means basically someone putting down less than 20% can now apply to have their mortgage payment amortized over 30 years. This is a significant announcement because it's something that not only has the mortgage industry and a lot of people in the real estate industry been advocating this for years on years, but it's been 12 years since this has been allowed to be an option for a borrower. And for those who don't know this, you can do a 30-year amortized mortgage if you're putting more than 20% down. So it was basically restricted only to those who had more than 20% down. And now today, if you have less than 20% down, you can do this. But here's the catch. You guys know this already if you've been paying attention to the news. It must be for first-time buyers only. So you must be a first-time buyer, and it must be for new construction only. So hold on a second here. You're telling me not only is a 30-year amortized mortgage for an insured purchase only available for first-time buyers, not anyone who's purchasing a property with less than 20% or who doesn't own a second property as a whole, but it's only for new build properties. Now, I don't know where you're located, where you're watching this right here, but we've got a few problems at play here. Number one, there aren't very many new build properties around, and the ones that are typically speaking pre-sale properties that are 18 to 36 to as far as 60 months out from being built. In most major cities, the biggest problem is there are not enough pre-built properties, which means we've got borrowers who are going to have to come up with deposits of 10, 15, and sometimes 20% to buy a pre-sale property, of which they intended on possibly putting 5 or 7% down. How is that going to work? Now, I don't know if there's going to be any special programs for their builders, or the builders are going to provide, lower deposits for people who have 5% down that are first-time buyers that are using this program. But are these things thought out? I'm going to assume no. They're probably not going to be thought out very well. But and additionally speaking, let's just keep going a little bit further than that. A 30-year amortization on new development less than 20% down. I mean, insured mortgages themselves make up for approximately 5% of the overall marketplace as a whole. Anyways, this is not going to move the needle or have any significant difference whatsoever. And my overall feedback right there is that while it might have a slight impact on who can, I guess, afford monthly payments I said 5%, basically less than 15% of these properties being insured, there's not really going to be a significant difference. In short, I'm at a loss for words. There's just really not more to say to that. There's no significant difference. Now, here's some interesting stats that you should pick out. Freeland announced that not only do we have to incentivize new construction, which yes, we do, but we also need to construct over 181,000 homes more per year on top of what we're already building. No shit. I think we know this at this point right now. So let's go on with the second part of the first-time homebuyer program. There is the RRSP homebuyers plan, which is, oh my gosh, been increased from $35,000 to $60,000 for home buyers who withdraw funds between January 1st of 2022 and December 31st, 2025. They will also get 5 years instead of 2 before they need to start making those repayments. The extra $35,000. Now, I don't know about you, but I don't know very many first-time buyers who are sitting on an extra $35,000, so $60,000 total before purchasing a property, and where I don't know anyone where an extra 3 years will have a significant difference on their ability to save up and pay back that extra $35,000. To me, this is basically, I don't even know. It's a call for votes. A call to action. Why not just take the first home savings account and just immediately give people $40,000 day one instead of making them wait 8,000, 8,000, 8,000, 8,000? A much more useful program that doesn't have the limitations of the 90-day period that the money has to sit into the accounts. All of this is basically a political ploy that is going to not only not move the needle, but probably provide frustration to home buyers. I can just picture it right now. I've got a home buyer who's looking to get pre-approved, a first-time buyer who wants to get pre-approved for their first property, and we can provide them with a pre-approval, but we can say, hey, this pre-approval amount is for a new purchase, new development property with less than 20% down. But if you purchase a resale property with less than 20% down, you have to qualify for that price point. Not only that, but we also have this stress test that you will have to qualify, which we've had for a long time. And don't forget, We have other limits that are coming up over and above that. Oh, and your down payment requirement is 5% on the first 500 and 10% for the amount above that, and on and on and on and on and on. I mean, this just gets more and more and more and more confusing day to day. I think if the government really wanted to have any meaningful impact on the housing market from a positive perspective to help first-time buyers get into the marketplace, then keep it simple. 30-year amortizations for those who need to purchase their first property under $1 million. All other rules apply the same as before. Don't complicate it. Heck, why not make it for someone who doesn't own a other piece of real estate less than 20% down? Why can't they qualify for it? Now, there's some questions that have been answered, which is, okay, can we qualify someone over 30 years instead of 25 years, which could equate to another 5% borrowing power? Or do they qualify for 25 years and we just let them use 30 years amortization for payments? I mean, if that's the case, then that's a whole other thing because it doesn't actually help people qualify for more. It just allows them to reduce their monthly payments, which is not a bad thing. But again, that's only on new build properties. So another consideration. The RRSP is, as I've quoted, seeing floating around all over the place, a nothing burger. It is not going to have any real or meaningful impact. My feedback is that generally speaking, I do see people plan to use their RSPs when they're buying their first property. But if I had to guess, I'd say 3/4 of them have not used the $35,000 worth of room. And there's very few that have used, let's say, couples using both $35,000 on either side. Again, not a significant difference. Now, some other changes that we've seen floating around as far as this charter of housing rights, or I don't even know what they're calling it right now, basically their overall housing plan announcement. We have a permanent amortization reduction, which is going to allow permanent amortization relief to at-risk homeowners. They didn't explain what is an at-risk homeowner and what does that mean. Essentially, they're basically saying that they can keep their payments where they are for as long as they need to, which, I mean, I'm all for letting people keep their homes, but I'd be curious to know how those banks or investors who are providing that money would feel. And what does that mean at renewal time? Do they have to go and stick with whatever they've been offered previously or the bank that they had? I think that's probably the likely outcome at this point right now. In addition to that, they will have to contact borrowers up to 24 months prior to your homeowner's mortgage renewal. Now, something that we typically do is stay regularly in touch with our clients on our team on a frequent basis. But it's interesting that the government thinks that by mandating the companies to do a better job of retaining their clients is going to have any positive impact in regards to the housing market from a financial perspective, other than the banks just making more money by retaining more potential clients and not having them walk away because they can essentially get them to sign on for an early renewal. Whew, that's a lot of information. And what I would say, as I'm walking through those details, I would love to hear feedback. So whether you're watching on YouTube, if you are watching this or listening to this on the podcast, follow me on @FlowMortgageCo or find me on YouTube. And definitely, I'd love to hear some different comments and feedback from people because so far I've talked to tens of real estate agents and a number of clients and asked for feedback. And I haven't found a single person yet that was really excited about the changes here. And if the Liberal government was trying to more or less buy votes, I think they did more hurt than anything to themselves when we consider the potential outcome of this overall housing policy. What a week. What a week. What a week. And there's more coming up. If you don't already know, there are some other. Now, actually, let me take a little sidestep here because I did want to mention that there was a positive piece of news. Yay for positivity. The government announced that there was a proposal to consult the mortgage industry to make some kind of tool available through the CRA to verify income for borrowers. Now, this is something that we've been waiting for a long time. And as a broker who pushes the understanding of people doing this correctly, and I'm someone who is a huge advocate of avoiding and eliminating fraud from mortgage applications because it does nothing positive to our overall marketplace at all. I am so grateful that they're finally talking about actually doing something. I'm just not very grateful or not very excited to see what they're actually going to do. Nonetheless, they're talking about putting some type of income verification program in place that will make sure that people do and make what they actually say they make, which is really honestly a good sign all in all. Other little things to think about here that were announced in this overall home buyer plan or home program from the Liberal government. They're talking about unlocking 2 million new homes 2 million homes where they're already struggling to build a few 100,000 each year. So that is what essentially the Liberal government is proposing to do. There is some interesting little tidbits. There are some, if you live in BC, you'll note that there was an announcement last year to offer some support for a secondary suite program, which had a lot of issues with it. We'll say that lightly. Now, there has been a consideration or a potential announcement of a low interest secondary suite program through CMHC to help homeowners add a secondary suite through the federal government. So it'll be curious to know how they're going to approach it from that perspective, and whether or not realistically that's going to move the needle in getting people to put secondary suites in their homes, unlike the BC one, which is going to have a significant amount of rules and guidelines, which aren't going to allow people to do what they want to do. Whew, that was a lot of information. In short, a lot of news, a lot of feedback, but probably not a lot of significant changes are coming at this point right now. I was just looking recently actually at a chart, and in that chart, it shows the number of insured mortgages. So for first-time buyers who are buying homes with less than 20% down, that number has been steadily declining from 35 to 40%, so about 38% in 2014 to today, where we're at about 15% of insured mortgages. That's an insane statistic. And it's a reminder that what this government is doing is not having a significant impact on first-time buyers' ability to get in the homes unless they have a significant amount of help, which is leaving a lot of people on the sidelines because not a lot of people can get family help to get into the housing market. So I, for one, do think that this overall program was a complete fail. And it is, probably not surprisingly, not going to have any major impact on the housing market as a whole. Whew, lots to chew on here. Other little quick tidbits, guys, if you're thinking about what's going on in the next couple of weeks and what to look out for, there's a lot of data coming out fast and furious. Some other interesting tidbits that could actually impact the housing market. There was an attack from Iran on Israel. And again, I'm not going to get political here, but the possibility is that that could impact oil prices. And if oil prices go up significantly, not only are we paying more at the pump, but that impacts inflation on the upper end. There's a lot of different things going on right now, and a lot of that can impact rates and what's going on term-wise. And I don't typically go too deep into these types of topics on a regular basis, but today we are because it has such a significant impact on real estate. Speaking of real estate, what's interesting to note is that we've had a significantly interesting up and down year so far in 2024. But looking at an actual statistic or a chart of what's going on in Canada, the crazy thing is that although the average home prices are down, median house prices are actually up. And in addition to that, we are still, based on sales to new listing ratios, not in a buyer's market, contrary to what a lot of suggestions are. We are still sitting at a balanced market, nationally speaking. Now, what I have noticed from an anecdotal perspective is that there are some markets that are still seeing a significant amount of activity, but we're also seeing some markets that are sitting and waiting. I, for one, believe that's because home sellers right now are predicting house prices to get back to where they were before, which was growing and going up significantly faster than what they are. The reality is house prices are going to be based on what people are willing to pay, and people are willing to pay because there's not enough supply out there. But the market itself is not going to support a significant growth when people don't have as much money as they used to have. That's it for me today, guys. If you like the show, make sure to leave that 5-star review and ratings, please, on Spotify or iTunes. If you're following this on YouTube and you want to leave me a nasty comment below, feel free to do so. If you want to say something nice, I'd love that too, and I'd appreciate it. Hope you enjoyed this day's episode, and we'll see you soon. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.